I've noticed that the people who worry most about retirement are often worried about the wrong thing. They're focused on whether their money will last, which makes sense because that's what every calculator and article tells you to think about. But what I've found is that clients who feel the most secure aren't necessarily the ones with the largest portfolios. They're the ones who understand where their income is actually going once they retire, and more specifically, how much of it they'll keep after taxes. Because the assumption most people make is that taxes will naturally go down in retirement because they're not working anymore. And sometimes that's true. But for a lot of retirees, especially those who did everything right and saved consistently in pre-tax accounts, that tax bill doesn't disappear. It shifts timing. Hi, I'm Tracy Schaff at Sterling Shire Investments, and I work with people who are trying to figure out what retirement actually looks like once you move past the idea of it and into the reality of funding it for 30 years or more. And one of the most common surprises I see when someone retires is that it looks like a strong financial position, only to discover that their tax burden in retirement is higher than what they expected, sometimes even higher than when they were working. That's not a planning failure. It's just how the system is structured when you've been saving in the right accounts for decades. Here's what happens more often than you'd think. Someone spends their entire career building up their 401k and IRA. The balances look strong. They feel prepared. Then they retire and suddenly they're dealing with required minimum distributions, Social Security, that's partially taxable, maybe a pension or some rental income. And all that stacks together in ways that pushes them into higher tax brackets than they ever anticipated. Once you've reached the required minimum distribution age, which is currently age 73 for those born between 1951 and 1959, and age 75 for those born in 1960 or later, the IRS requires you to start taking money out of those pre-tax accounts, whether you need it or not. And if you've been diligent saver, those required minimum distributions can be substantial. Add in Social Security on top of that, and you may find your taxable income in the early years of retirement is comparable or maybe even higher than what you earned in your final working years. What's interesting is how this builds over time. Your RMDs isn't a fixed amount. It increases as you age. The percentage that you're required to withdraw generally goes up gradually each year, which means even if your account balance stays relatively flat, that distribution amount keeps climbing. And if your investments do well, your RMDs grow even faster. So you're in this situation where success in savings actually creates a larger tax obligation down the road. That creates a compounding effect that catches people off guard. They'll plan for their first few years of retirement, maybe model out their spending and their expected tax rate, but they don't always account for how that changes once RMDs start and how it escalates as they move through their 70s and 80s. The tax burden doesn't stay static. It tends to increase. What makes this more complicated is Medicare. If your income crosses certain thresholds, your Medicare Part B and Part D premiums increases through something called IRMAA, Income-Related Monthly Adjusted Amounts. These surcharges kick in at modified adjusted gross income levels starting at $106,000 for individuals and $212,000 for married couples filing jointly in 2026. And they can add several $100s a month to your healthcare costs. So now you're not just paying more income tax, you're also paying more for the exact same Medicare coverage someone with slightly lower income gets. The thresholds are tiered. So smaller changes in income can trigger a disproportionate jump in premiums. And because IRMAA is determined by your income from 2 years prior, it's not always intuitive to connect the decisions you're making today with the premium increases you'll see later. That delay makes it harder to plan around unless you're specifically thinking about it. Then there's Social Security taxation. Depending on your total income, up to 85% of your benefit can be federally taxable. A lot of people assume Social Security is tax-free, or they think it only affects the wealthy retirees. But the thresholds haven't been adjusted for inflation in decades. For single filers, that threshold starts at $25,000 in combined income. For married couples filing jointly, $32,000. More people get caught up in this every year without realizing it was coming. What's particularly tricky about Social Security taxation is the formula. It's not straightforward. Your combined income, which is your adjusted gross income plus half of your Social Security benefits, plus any tax-exempt interest, determines how much of your benefits gets taxed. That means a Roth withdrawal won't trigger Social Security taxation, but a traditional IRA will. So the account you pull from actually changes the math. If you'd like to see how this could fit into your overall plan, you can book a quick call using the link in the description below. Here's why this matters more than surface level suggests. When your effective tax rate goes up in retirement, you're not just sending more money to the IRS. You're directly reducing the actual spending power. That $100,000 you pull from your IRA might only give you $75,000 or $80,000 after federal and state taxes are withheld. And if you weren't planning for that gap, it fundamentally changes what your retirement looks like. The psychological shift is a significant one. You've spent your entire working life seeing your accounts grow larger and larger, feeling like you're building towards something. Then you retire and suddenly you're in distribution mode. The numbers are going down. You're paying taxes on money you thought of as yours, and it can feel like a goalpost are moving. That's harder to navigate emotionally than most people expect. The real challenge is timing. By the time most people realize this is happening, they've already locked in much of their structure. Their accounts are predominantly pre-tax. They've started Social Security. They're taking RMDs because they're required to. At that point, the option for managing tax impact becomes much more limited. That's why planning ideally happens earlier, in the year just before or just after retirement, when you still have flexibility. That's when you can control the timing of Social Security. You can manage how much income you're recognizing. You can explore strategies like Roth conversions to move money out of pre-tax accounts during lower income years, so that it's not all forced out later when RMDs take over. This window between when you retire and when you're required to start taking distribution is often the most valuable planning opportunity people have. If you retire at age 62 or 65, but you don't need to start RMDs until age 73, that's nearly a decade where you have much more control over your taxable income. You can potentially stay in lower tax brackets, do conversions strategically, and set yourself up for a more efficient tax situation in later years. Roth conversions aren't universally right for everyone, but they're worth examining if you're in that gap between retiring and claiming Social Security, or if you have a year with unusually low income. The concept is straightforward. You pay tax on a portion of your IRA or 401k today at your current rate and convert it to a Roth IRA where it grows tax-free and doesn't add to your RMD calculation later. It creates breathing room down the road. The calculation isn't just about today's tax environment versus future tax rate, though that's part of it. It's also about how that conversion affects your entire income picture going forward. Small RMDs mean potentially less Social Security taxation, lower IRMAA surcharges, more flexibility in managing capital gains, and all those pieces connect. But even beyond conversions, just being deliberate about the sequence in which you draw from your accounts can make a meaningful difference. Spending from taxable brokerage accounts first, or strategically using Roth dollars to stay below certain income thresholds, these decisions accumulate over time. There's a logic to withdrawal sequencing that isn't always obvious. The conventional wisdom used to be that you should spend your taxable accounts first, then tax deferred, and then Roth money. And in some situations, that still makes sense. But when you factor in things like Social Security taxation and IRMAA, sometimes it's better to pull from Roth earlier to keep your modified adjusted gross income lower, even if you're preserving that Roth money less. The point is that there isn't one universal answer. The right sequence depends on your specific tax situation, your income needs, what your balance looks like across different accounts types, and what you're trying to optimize for. But having a strategy rather than pulling from whatever account feels convenient makes a difference. What I have seen consistently is that people who treat taxes as part of their income strategy, not just something that gets handled once a year in April, tend to keep significantly more of what they've saved. They're not reacting to surprise tax bills or trying to appeal to an IRMAA surcharge after it's already been assessed. They've woven the tax considerations into the plan from the start. And to be clear, this isn't about eliminated taxes. You're going to pay taxes. The question is whether or not you're paying them efficiently in a way that aligns with your overall plan, and whether you're paying more than necessary simply because no one thought through the timing. The other thing that gets overlooked is the long-term impact. A few $1,000s in extra tax in 1 year might not feel catastrophic, but over 20 or 30 years of retirement, those efficiencies compound. They reduce what you're able to spend, what you're able to leave to your family, and how much flexibility you have if something unexpected comes up. The difference between managing this well and not managing it can be significant. Real confidence in retirement doesn't come from having the largest account balance. It comes from understanding how your income sources, tax situation, and benefit programs interact and structuring things accordingly. If you want a second opinion on your plan, book a time with me using the link in the description below.